COVID-19, the global economy is at a standstill. Markets are in turmoil.
The S&P 500 opening lower by more than 8%. Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
And hello and welcome to Bloomberg Invest Global Day 2. Thank you for joining us from wherever you are in the world. I'm Haslinda Amin, anchor with Bloomberg Television. Over the course of 3 days and across several regions, Asia, the Middle East, Africa, Europe, and the US, we'll speak with many of the most influential names in finance, investing, and economics today. Well, we hope the conversation will help you make sense of the extreme volatility we're seeing in global markets and to understand the near as well as far-term opportunities as well as risks. Today, we're talking about the new world order as we emerge from the depth of COVID-19 after lockdowns paralyzed economic activity across regions with factories getting shut, manufacturing coming to a standstill. Policymakers have announced massive monetary and fiscal stimulus measures in an effort to mitigate the economic fallout, prevent bankruptcies, debt defaults, save jobs. As we emerge from the abyss, it does seem like some profound long-term trends are also emerging. What does it mean for policymakers, businesses, investors? Today, we get insights from the sharpest minds in Asia, stretching from Australia to Indonesia, Singapore to Hong Kong, and India. Before we begin, just a couple of housekeeping notes. Make sure you're using Firefox or Chrome to view the sessions. If you're having any trouble with the audio or the video quality, all you need to do is to refresh your browser. You can restore Windows using the buttons at the bottom of your screen, and the size of each window is adjustable. Of course, this is an interactive event. We welcome your questions. To submit one, all you need to do is to type it into the Q&A box below the slide window, click submit, and please do include your first name, your city, as well as the question that you'd like to ask. Also, we'll be doing polling questions throughout. You'll see the question pop up on your screen as we're talking. Do send us your responses. Also engage with us on Twitter using hashtag BloombergInvest. That's on Twitter, hashtag BloombergInvest. Before we get to our first conversation, let's do the first polling question. And the question is, are you ready? Are you ready? Is there a limit to what central banks can do to shore up the markets? Is there a limit to what central banks can do to shore up the markets? I know that indications so far have been like, they'll do whatever it takes. So is it smart policy implementation to a certain extent, unlimited? Is there a limit to what central banks can do to shore up the markets? Do give us your answer to that, your views, and we'll bring you, the answers to be collated later on. Now, first up, let's turn to Indonesia, a country of 265 million people, the largest economy in Southeast Asia today, set to be the fourth largest in the world by 2050. Indonesia is still struggling with a surge in pandemic cases, even as it eases restrictions in the capital as well as other cities in the country. Its growth outlook remains muddled as the pandemic has battered small and large businesses alike, ravaging the economy, bringing economic activity to a halt. Prime Minister Joko Widodo says the situation is dynamic and changing every week, every month. Its growth projection has been cut several times, with the finance ministry now warning the economy could shrink this year. Earlier, I spoke with Indonesia's finance minister, Sri Mulyani Indrawati. I began by asking her about her stimulus plans.
Well, we are not really actually assuming that the COVID is going to only last 6 months. The design of our fiscal as well as all the policy response is actually expecting, or at least we know that there is COVID and how it will end is so uncertain. And that's why the way we respond to this, first, for 2020, we really focus on how we are going to use on our fiscal side, the budget stimulus, and changing the way we govern and design our budget to respond to this COVID-19. Whether this is on a health, whether this is on a social safety net, or on protecting the small, medium business, and how we are going to stimulate again the economy, especially on the second half. The way we designed this for 2020 is actually to cover until December. Now we are still discussing at the early stage with the parliament for 2021 budget. So it's not really like the Indonesia only preparing for 6 months. For example, for the health, this is going to continue for until December, and we are designing how we should continue design the health spending for 2021. For social safety net, most of the social safety net has been extended until December, and now we're discussing with the parliament how we are going to design for the next year, 2021 budget design for the social safety net. We are doing also a reform on that area. And then for the support for the business, especially small and medium enterprises, it is designed for 6 months. But until now, we are still actually discussing with the banking system how we are going to implement. Some of it is already in place and need for the bank to do the restructuring, and we are going to support those restructuring. So basically, this is really a very dynamic, and we are not really, in this case, is only preparing for 6 months.
If you do need additional stimulus, how will you find the resources to fund it?
Yeah, well, the resources, the budget is definitely affected in many ways. First, our revenue will be contracted by our estimation now 10%, both in terms of tax and non-tax revenue. As you can imagine, many businesses now closed, or they are at least quasi-closed, almost closed. And that's why their volume of activity declined. We are expecting the second quarter of this year, the GDP will be contracted by minus 3.8%. So this is going to definitely affect our revenue. But in addition to that, we also launching a lot of incentive. And that is actually creating and providing incentive in terms of relaxation or cutting the corporate income tax. This is creating also additional pressure on the revenue. But it's okay because the economy is still in a very, very big pressure from this COVID. And then we also have the spending side, which is increased quite substantially from the health as well as for protecting the people, so social safety net. The deficit is widened from originally the budget is 1.76% of GDP into 6.34% of GDP. How we are going to finance that? First, we are going to get the support from first using our own resources. As you can imagine that last year or through many years before, we accumulated what we call it unspent revenue. Or financing, and this is going to be our last resort to actually spend during this situation. We also use many of the sovereign fund, which is allocated, for example, for education. They actually are managing quite substantial money who can then buy government bonds. We also increase support from multilateral and bilateral support Basically, World Bank, ADB, even AIIB, Islamic Development Bank, they are all want to support Indonesia by increasing, especially on this pandemic response policy. And then we issue bonds, of course, from global and local. On global, we've already upsized, and from local, we are discussing with Bank Indonesia because they are not allowed by our law to buy the bonds on the primary market.
Right. You talked about Bank Indonesia. Members of the Budget Committee increasingly asking for Bank Indonesia to shoulder more of the stimulus costs, even buy bonds from the government at zero coupon rate. How feasible is that?
Well, Indonesia may be different from many other countries, for example, like Federal Reserve or many central bank in ASEAN, that their mandate on the central bank is actually wide. In this case, not only just inflation or exchange rate. Bank Indonesia, since ASEAN financial crisis, Indonesia banking crisis 97-98, has been created to become or recreated to become an independent central bank with a very focus only for inflation or stabilization of the rupiah. So this is really a constraint for Bank Indonesia to actually allow themselves to also shouldering the burden. If you look at many other central banks like Federal Reserve or Bank of Thailand, they are actually doing their part by involving directly to the economic activity. For example, like in Thailand, the central bank said that they do even bond stabilization fund for the corporation. So they actually can lend directly to the private sector, not through the banking system. This is not the case for Indonesia. So what we are doing now, while at the same time, everybody recognizes that COVID definitely affecting economy severely. And that's why for us, for Indonesia, we have one possibility which is provided by our emergency law that allowing Bank Indonesia now to finance the government deficit, especially for the COVID related, through primary market. And now the discussion is, of course, we have an agreement with Bank Indonesia to allow this to still continue using the market mechanism. But we also see that the market sometimes is very volatile. So we're discussing with Bank Indonesia how we are going to share the burden in a still credible way that allowing market to still continue function, but at the same time allowing government of Indonesia, in this case our budget, to have a certain burden to be shared by the Bank Indonesia. So this is what we are still discussing with Bank Indonesia. We are not using what we call it, or we are not yet decided about what kind of instrument that we are going to use. So for example, the word zero coupon bond is not really exactly like that. I'm still discussing with central bank about what kind of instrument which allowing Bank Indonesia to share burden. But in the medium long term, we still continue have to maintain the credibility of fiscal monetary authority in managing the macroeconomic discipline in Indonesia. So this is really a very fine balance that we, Bank Indonesia and myself, Pak Perry and myself, really try to establish how we are going to manage this very shocking effect from the COVID. But at the same time, we don't want to destroy what is actually the good achievement of Indonesia of managing and maintaining a good prudent macro policy. So this is the situation that we are having.
In a country like Indonesia, Minister, where monetary policy transmission is pretty slow, how significant are central bank policies in supporting growth?
Well, this is exactly the challenge that we are discussing. Because even Bank Indonesia is already do their part, for example, reducing the reserve requirement, they also reducing the interest rate, but the transmission of the monetary policy into the real sector activity that is stimulating the economy is quite limited. There are a couple of challenges that Indonesia is still facing. For example, like we are actually looking at the situation, whether the intermediary function, is it constrained by the structure or the shallowness of the financial sector in Indonesia. We also look at why the banking sector is not transmitting this to the real sector. So if it is in the US term, Wall Street to the Main Street. This is how we are actually now discussing how and what instrument we should do. So for example, that this may require government involvement, whether this is related to the risk. For example, banking sector doesn't want to lend, especially during situation, and their interest rate is stubbornly still widened in terms of their gap between the policy rate of Bank Indonesia and the real rate in the Main Street in this case. So this is the one that we are discussing with Bank Indonesia as well as the banking system or OJK. The pass-through effect of the reducing interest rate and reserve requirement is actually try to stimulate economy from the monetary side and banking side. While the government of Indonesia, from our fiscal side, we also stimulus the economy through our spending. Now we are trying to combine the instruments so that the effect to the real economy can be actually felt more effectively.
Minister, just last week, you candidly said that if there is a second virus wave, you can only pray, in your own words. What kind of contraction could we possibly see in the Indonesian economy if that were to happen?
Well, I have to put it in a context. First, as a minister, and we are still, as I said earlier, that we are not only focusing on 2020 budget, we just still continue very dynamic, and that's why we actually proposing to the parliament the changes of the budget even already twice now. This is because we always continue adjusting how we are going to respond to the development of this COVID-related situation, whether on a social economy or even in the banking system. The second one is also because the nature of uncertainty itself. At the same time, I have to prepare the 2021 budget, which the president is going to submit to the parliament next August. So you can imagine that you are preparing something for 2021 while you actually still cannot control and really don't know how this is going to evolve. Because I think no country in the world can claim that I'm now safe, nothing will happen. It's not going to be that way, right? So what we are going to do is actually try to prepare of this kind of scenario. If there will be no second wave, that means the recovery on the economy for the fourth quarter or beginning very early on the third quarter of this year will accelerate it to 2021. So then what kind of policy design that we are going to do in order for us to be able to accelerate this recovery of the economy? This is really, I mean, you are making a policy that is the commitment will last for the next 12 months for next year, while we are still in a very uncertain time. I think if I said that we have to pray, I think this is the most the humble thing that any human being can do during this kind of situation. So basically, we will try to do our best, and we always continue praying that this is going to last in not so long time.
Minister, what are your views on the rupiah? It has stabilized, is up about 15% year to date. It's recovered almost all its losses from the March turmoil. But Governor Periwarjio says the rupiah is still undervalued. Do you share the view? Is there a fair value for the currency?
Well, first, the rupiah is always affected by the fundamental, which for Indonesia, before COVID, we are actually addressing the issue of the fundamental that support our fair value of rupiah, whether this is on a trade balance or on a current account balance. And that's why what is the government doing? Try to boost export by increasing productivity and competitiveness. We also reforming our economic policy, so it will attract more capital so that the current account is going to be positive. We also boosting, for example, our tourism. This is also one of the potential to generate the foreign reserve. So these are all things that we are doing in order to address the issue of the Indonesia fundamental to support our rupiah. On the other hand, we also know that the rupiah is also affected by sentiment, or is even in this case, the dynamic in Wall Street or in Europe is going to also affect our rupiah. And this is the situation in which we are facing today. No one can actually describe it well, but saying that all the dynamic is actually starting to increase with the geopolitical, what is happening between US and China and Europe, and that's create a sentiment. So the COVID adding to all those dynamics. And we see that, for example, during March and April, when this panic on the financial sector is really affecting all the emerging country currencies. So for Indonesia, I think what is happening today in May and June, when relatively the sentiment, at least digesting this COVID situation relatively now well, at least they recalibrate their assessment of the risk. Then we see that rupiah settle in an equilibrium, which is less affected by this panic and herd behavior, and is more supported by the fundamental. And then in the future, I think what Bank Indonesia is continue doing is actually, on the one hand, we will look at all this competitiveness, that is the fundamental to support rupiah, that is our productivity, competitiveness, and policy on investment, boosting export, as well as all that is a foreign reserve generating activity. On the other hand, we also improve our flexibility on the rupiah as shown by Bank Indonesia. So with that, I think we will look at the flexibility of the exchange rate as one of the shock absorber when the situation is really very dynamic.
But I guess even the question is whether a further appreciation in the rupiah would affect the overall economy. Would it be beneficial for the overall Indonesian economy if the rupiah was stronger?
Well, we certainly know that any currency, if it is too strongly appreciated, will basically affecting the competitiveness of those economy. But on the other hand, if it is too depreciated, it's also affecting the sentiment against those economy, whether they are perceived as weak or in this case vulnerable, or also in this case, in our case, on many other country cases, is actually also can affect our imported inflation. So basically what I'm saying is that we are not aiming for a certain level, but we are aiming for stability with some flexibility, which, as I said, exchange rates become one of the shock absorber. So in this case, I think Bank Indonesia and ourselves is going to focus on how we are going to improve the fundamental of our economy. On the other hand, we also want to make sure that the level of rupiah will reflect those fine balance between the perception as well as the fundamental of the economy is actually there, as well as the competitiveness of the economy, especially those related to the open market, that is the global economy, is going to be preserved. That is the competitiveness which is not going to be, what you call it, affected negatively by a level of rupiah which is distorted. So it's really a fine balance on those two.
Minister, you are Managing Director and Chief Operating Officer of the World Bank. I'd love to get your views on the challenges ahead for the global economy as they pull back the stimulus. It's still too early for central banks and governments to be pulling back, but they have to make arrangements for that. How do governments begin to rein in that debt? And at the end of it, when the music stops, how much of mopping up do governments and central banks have to do?
Well, this is really, I mean, we are still in the middle of this COVID, and no one knows how this is going to end. Of course, everybody will get all the best effort to get the vaccine. But during this particular extraordinary time, the government have to use all the instruments to actually help the economy and the people. And that's exactly what all country is doing. Of course, the effectiveness of this, how the government design policies depend on each country. For example, how you are going to spend on the health sector, how you are going to spend on the social safety net, how prepared or how good the data, how robust the mechanism, how effective this response, how you are going to support the small, medium enterprises, how you are going to make sure that the banking system is going to continue stable and robust. These are all the challenges that are facing by all countries in the world, which is now facing the COVID threat as well as the economic downturn threat. And the fiscal expansion as well as even monetary expansion is unavoidable. The question is not why you're doing it now. I think it's so obvious the reason why. But the question which is how you are going to make sure this is not going to continue to become a habit of non-disciplinary fiscal and monetary policy. And in this case, each country have their own. My own for Indonesia, we are lucky enough because in the past 20 years with the fiscal discipline rule and the independence of the central bank, we have the institutional arrangement that allowing this discipline to be adopted. And even in this case, by the parliament or supreme audit, they are always actually creating a check and balance to us. So I'm sure in this case for all countries, after this year big spending, you have to continue thinking now how you consolidate your fiscal. This is exactly what we are doing in Indonesia. Next year, we definitely aiming for deficit lower, and we are going to make sure that we are going to have a fiscal discipline path in the medium long term.
I guess a follow-up question to that is that we've seen how stable the bond markets have been. Would it be tempting for governments to carry on spending?
Well, this is exactly, I mean, the bondholder will really see whether they make a judgment, whether this kind of spending justified or not. If this is just reflecting a reckless spending or just the government just want to have an easy spending by issuing more and more bonds, I think they don't have the trust and confidence on the bonds. But if they see that the government really calculating well and very carefully why we are spending this much and for what and for how long, then they are going to be able to make and calibrate this risk well and reflecting their price. And you see that Indonesia on the issuance of bonds at the global level is actually have a very, very good year, even in a very, very difficult time last April and then the latest one 2 weeks ago. So I think it's fine. For each country, you really have to establish a credibility on your policy and how you are going to tell the bondholder about what is the real and good price of your bonds. This is related to your own policy framework and the fiscal policy discipline that is committed by the government.
Minister Sri Mulyani Indrawati, thank you so much for your insights today. Been a pleasure.
Thank you, Aslinda.
And that was Indonesia's Finance Minister Sri Mulyani Indrawati. Of course, the country wants to be the fourth largest in the world by 2050. The second term of President Joko Widodo was supposed to, push the country to being among the largest in the world, but it's had setbacks to do with this COVID-19. Now, before we continue, I'd just like to bring you the results for the polling question which we gave earlier. And the question is there a limit to what central banks can do to shore up the markets? 8% say no, smart policy implemented correctly can stave off the worst effects. We have 55% voting for, to a certain extent, unlimited rate cutting isn't a long-term solution. And we have 35% saying yes, there's a limit to what central banks can do to shore up the markets. Central bank divergence and unlimited borrowing bring significant risks. So pretty divided there in terms of to a certain extent, as well as yes, to a certain extent, is 55% of you voted for that, and 35% voted for yes, there is a limit to what central banks can do. Now, as Indonesia continues to struggle with the pandemic, Australia has successfully emerged from it, but severe damage has already been done. It is in the midst of its first recession in 30 years, its jobless rate at a 19-year high. The impact is also reverberating in other areas like consumption, housing. For insights, here's Australia's Treasurer, Josh Frydenberg. Treasurer Frydenberg, thank you so much for joining us today. Now, the RBA says it's likely that fiscal and monetary support would be required for some time. Is that your view as well?
Well, in terms of monetary policy, we already have a very low cash rate here in Australia, like other countries around the world. So monetary policy has been working hard over the course of the pandemic and in the lead up. In terms of fiscal policy, we've announced the equivalent of 13.3% of GDP in terms of financial and economic support, some $260 billion. And that support is in the number of forms. It's coming out in terms of support for the cash flow of small and medium-sized businesses. It's in the form of wage subsidies and direct income support, cash payments to households, and particularly pensioners and others who are on other forms of income support. So we're putting in place a comprehensive range of measures, and certainly used our balance sheet to effect.
There are concerns about the fiscal cliff. I mean, you're the architect of the JobKeeper program, which is due to expire in September. Is there a sense that it will be extended?
Well, the JobKeeper program is currently under review. You're right, it's legislated to the end of September. It's a very significant wage subsidy program. It's a flat payment of $1,500 per fortnight. There are more than 3 million workers who are on that. But we recognise that some sectors will recover faster than others, particularly as the restrictions are starting to ease. We're seeing the hospitality businesses, the retail businesses be more busy. But at the same time, as long as those international borders are closed, tourism is going to hurt.
So that would mean that you may extend the JobKeeper program for certain sectors. Is that a fair assessment?
What we've been looking at is sector specific support. So, for example, when it comes to the construction sector, we've announced cash payments to households who undertake a new build or a substantial rebuild of their property. We have announced some infrastructure projects that will be brought forward, working together with local and state governments to boost aggregate demand and of course, employment. We've also announced specific measures for the tourism sector, recognising the strain that they are under, and we're in discussions with the arts sector, recognising that as long as those social distancing laws are in place, it's very hard for them to fill a venue, so to speak. So we recognise that some sectors need additional support, and that's what we've been doing in terms of the JobKeeper program. That is now the subject of review.
You talked about tourism. The international tourism industry looks like it's going to be dead for a while. What's the advice to people who've lost their jobs in that sector? Do they hang on till it reopens or find alternative work?
Well, in terms of Australia's tourism market, 70% of the activity is actually domestic tourism. We are starting to see the border restrictions being closed between states within Australia, and that will be good news for activity in the tourism space. But you're right, for those that rely on international tourists, and Australia has been a destination for many of those in recent years, that sector's being hit hard. No doubt there'll be some adjustments in terms of how they operate, but as long as those international borders are closed, I think that sector is going to really feel the effects.
When it comes to that JobKeeper program, Treasurer, when it starts getting pulled back, will it be a tapering or will it be cold turkey, you think?
Well, they're all the questions that we are considering as part of the review. What we do know is it's been very successful in maintaining that formal link between the employer and the employee. And unlike other countries that put in place similar wage subsidies for 3 months, we've legislated it for 6 months, recognising that the supports would be required for some time. But as I said, it's one of a number of measures that we have put in place to support the economy at this time. We also have a $30 billion cash flow boost, which provides financial support to businesses based on the size of their payroll, and that money can be used to reduce their labour costs as well as meet some of their fixed costs. We've also made a number of regulatory changes around insolvency and bankruptcy laws, and other red tape reductions to provide a regulatory shield for businesses through the COVID crisis. So it's not just financial and fiscal support, it's also regulatory changes that we've undertaken to support the economy.
I guess the thinking behind that question has to do with Canada, for example, has been trying to get millions of its people off government support. And it's one of the trickiest issues in its recent history. I mean, what's the situation with Australia? Might that mean a job reallocation, further unemployment? What could be a result of that?
Well, the most recent unemployment numbers showed that they increased to 7.1%. And, you know, that was for the month of May, and that reflected a lot of people losing their jobs over April and May at the height of the crisis. Not forgetting that we actually entered this COVID pandemic from a position of economic strength. We saw unemployment fall to 5.1% in February. We balanced the budget for the first time in 11 years with a strong current account surplus. We had the lowest welfare dependency in 30 years, and we had the largest tax cuts in more than 20 years. So the economy in Australia had approached this crisis from a position of economic strength. But we are definitely seeing the impact both on GDP and output, but also on unemployment as a result of these health restrictions. But because we've had more success than most nations in flattening the curve, we are now starting to open up the economy. So we have an agreement between the federal government and the state governments to lift the restrictions in 3 separate stages, and the culmination of those restrictions being eased will see the economy benefit by more than $9 billion a month, and more than 850,000 people get back to work. So while the unemployment numbers are certainly always too high for our liking, we are starting to see some progress with consumer confidence coming back, business confidence coming back. The equity markets have been elevated. The Australian dollar has risen off its lows, and I think and the economy is moving in the right direction.
So you're saying there's no risk of unemployment getting to double digits in the next few months?
The unemployment number will get higher in the coming months, and we've said that publicly.
Double digit possible?
Well, what we have said so far, and we'll provide an update in July, is that we think it's reaching about 8% in the September quarter, and as I said, it was 7.1% in the month of May. So it will rise, but with the restrictions being eased, we will start to see more people come back into work, and that's a good thing.
You talked about the reopening of state borders, but we're also seeing perhaps a second wave in Victoria State. I mean, could that hamper reopening efforts?
Well, obviously, what we've seen in the state of Victoria, as you say, is a number of new cases. But authorities are working hard there to ensure that the testing and the tracing systems are in place. We also have a COVID app where more than 6 million people have downloaded an app on their phone, which will also help stem the increase in cases. And we've got good cooperation between governments and health authorities. So let's see how that plays out in the coming days. But certainly the state government is focused on stemming that increase in cases.
Treasurer, amid all the challenges, relations with China continue to deteriorate further. The government is being applauded in diplomatic circles for taking a more hardline stance to China, not bowing to economic coercion as Pompeo described it, but with the threats of consumer boycotts and Beijing warning against students, tourists coming to Australia. There are concerns of the economic cost. Wouldn't quiet diplomacy work better?
Well, the first thing to say is the Australia-China relationship is very important to both countries. We have more than $200 billion a year in two-way trade, and increasingly as the Australian economy becomes more services orientated, our services are desired by Chinese markets, and so it's mutually beneficial. We supply a lot of the resources that underpin the growth story in China, as well as our agriculture being first class. And for us, we welcome Chinese tourists, Chinese students, as well as providing a good market for Chinese exports as well. But we will also be very consistent and clear when it comes to protecting our national interest. And we have done so in the past and will do so in the future. And we make no apologies for that.
But China's hit barley, beef, tourism, education. Is it an option for Australia to perhaps cut its economic dependence on China?
Well, like I said, the relationship works to the benefit of both countries. I mean, we supply more than 60% of China's iron ore imports. And that iron ore imports is used in the making of steel and underpins their economic growth. We're also a major supplier of coal and supply more than 40% of their LNG. And that gas helps underpin, again, their economic story. So China does rely on Australia for key imported materials and agricultural products. And we have a strong economic partnership with China, and we want that to continue. But when it comes to key strategic and geopolitical issues, we'll stand our ground.
China, of course, a lead partner in RCEP, Regional Comprehensive Economic Partnership. Negotiations are ongoing today. Do you expect Australia's diplomatic woes to China to cause problems in negotiations?
No, I don't. Australia has been a trusted partner in free trade agreements, both multilaterally and bilaterally. Indeed, when we came to government, we saw 26% of our two-way trading relationships covered by free trade agreements. Today, it's over 70%, and the expectation is it will get to 90% by 2022. We've struck bilateral free trade agreements with China, with Korea, with Japan. We played a key role in the conclusion of the Trans-Pacific Partnership. We've recently signed a deal with Indonesia, Hong Kong, Peru. Other partners are important for Australia. So we'll continue to support free trade because that's in Australia's interest and that is in the globe's economic interest as well.
When it comes to RCEP, shed some light on what the sticking points are, and realistically, when do you expect those talks to actually reach a conclusion?
Oh, look, lots of countries have their bilateral and multilateral trade issues, and they cut across sectors. I won't get into litigating it right now, but what I will say is we have pretty clear interest when it comes to these trade deals, whether it's the movements of people or the movements of goods and services, and we'll continue to advocate that behind closed doors.
Treasurer, we're talking about a new world order post-pandemic. In your view, what's the biggest change the world will see post-COVID-19?
Well, I think there's an interesting story about global supply chains and how stable and durable they are in post-COVID pandemic. I think they're vitally important. They provide economies of scale as well. But countries through this COVID pandemic have seen themselves having to find what is called PPE or other medical supplies at short notice, whether they are the masks or indeed whether they are the ventilators. I mean, we are prepared for the worst. We went out and bought 5,500 ventilators in addition to what we currently have, expecting a surge in demand with COVID. Right now, we only have 2 patients in an Australian hospital on a ventilator as a result of COVID. So we're prepared for the worst, but fortunately, we've had success and progress in flattening the curve. But what it did say to us was the importance of having a domestic capacity to manufacture certain goods in the event of a crisis. And I think many other countries are having the same conversations within their own parliaments. So going forward, I think you'll see countries be a little bit more self-sufficient in key areas, but this is not an excuse for protectionism. You know, we very much benefit as a country and as a globe from free trade, and we wouldn't want to see additional self-sufficiency in some niche areas be an excuse for protectionism, because I think that would be counterproductive.
How do you see the global economy recovering? V-shape, W, U? Are there signs suggesting either one?
Well, the OECD, the IMF, and others have been a little pessimistic about where they see the global economy this calendar year, but they are also expecting the economy to pick up next calendar year. So, for example, the OECD have talked about a fall of around 6% this calendar year. That's a big drop. Here in Australia, the drop will be slightly less than that, at around 5% according to the OECD, but the Australian economy is expected to grow by 4.1% next year. So I think that some sectors will recover faster than others, and that is a result of, you know, the international borders being closed. But I'm hopeful for the economy next year, after what is going to be a year to forget this year.
On that optimistic note, Dr. John Frydenberg, thank you so much for your insights today. It's been a pleasure.
Lovely to be with you. Thank you.
And that was Australia's Treasurer, Josh Frydenberg. Now let's move from policy to markets. And when it comes to markets, geopolitics are back at the forefront. President Donald Trump says the U.S. could pursue a complete decoupling from China, his most forceful statement yet on the souring ties with Beijing. Bilateral ties further strained after China pushes ahead with its plans to include a security law in Hong Kong's constitution, despite the G7 urging Beijing to reconsider. Hong Kong, of course, increasingly becoming the battleground for rising Sino-US tensions. Ground zero, collateral damage, putting at risk its future as a global financial hub. Now, let's get insights on how Sino-US tensions will play out in the market. Also, the challenges and opportunities with Chia Ching-hai, co-chair and co-CIO of Value Partners. This is a boutique company founded in 1993 with about $11 billion in assets under management and annualized returns of almost 14% since inception. Mr. Chia, good to have you with us. Great timing to be joining us because just hours ago, we had the markets react really violently when Peter Navarro was cited as saying that perhaps the trade deal with China is dead. He has since said that he was misunderstood. Talk to us, put things in perspective for us, this escalating Sino-US tensions, which is one of the biggest geopolitical risks in the market.
Thank you, Haslinda. You're right. The major uncertainty facing equity investors, especially in the China-related markets, is the rising tension. In fact, the crisis, the worst crisis we've seen in something like 30 years in the relationship between China and the United States. Now, I believe that we have to look past this crisis. In fact, logic and necessity makes it a compelling and logical situation where the United States and China will have to become partners and possibly friends and allies again. If I may, I will just go into some details of this. In fact, the US and China together make up roughly 42% of the entire global economy. China is moving to become the world's largest consumer market, and something like 31% of the annual growth in consumer spending in the world comes from one country, China. So a decoupling between China and the United States makes it practically impossible to find solutions to the world's issues and problems. The relationship is just too important. I would argue that China and America, in fact, are complementary powers. They are not competitive powers. It's very different from the situation with the Soviet Union, where both were striving for global domination. China, as far as I can see, is not seeking to export its ideology to the rest of the world and has said many times that it is quite happy to let the US exercise global leadership. So, on this basis, I would imagine that after the elections in November, we can build on the phase one trade deal. The trade deal is very much intact. To use Trump's words just a short while ago this morning, the trade deal is fully intact, and we can move on to build on it. And I would expect that the future direction of US-China relationship will in fact be moving more towards cooperation out of sheer necessity.
For asset allocators like yourself, Mr. Chia, what are the most pressing issues?
Yes, as mentioned, we have this Sino-US tension, which is actually the major overhang. And of course, we are looking at how the world recovers from COVID-19. In the case of China, the news has been more positive than I had expected. As recently as early April, I thought China can only look forward to a U-shaped recovery of sorts. But in fact, I was too pessimistic. China is decisively moving into positive growth territory. It's a V-shaped recovery. Overall, China's growth this year should come in at about 2%, I estimate. In fact, just so you know, the world's best performing major market this year, in fact, is China. The Shanghai Composite CSI 300 index already year to date is in positive territory.
So on the one hand, we have geopolitics, the US-China tensions. On the other hand, we have COVID-19. How has COVID-19 impacted your asset management business?
We have been cautious. But in fact, our flagship fund, Value Partners Classic, which is more than $1 billion US in size, already is a break even, more or less break even, maybe like down 1% year to date. We are following China's recovery quite well. Some of our funds, which are mostly invested in Chinese A shares, have recorded gains so far this year of more than 10% already. Yeah. I want to go back briefly to the theme of looking past the current crisis in Sino-American relations to a brighter future. Because I think the world has become very fixated on the idea that the two of them are decoupling, etc. But the figures don't show that. I put a lot of effort into trying to find out what the reality behind the headlines. I think, in summary, basically, politicians do politics, but businessmen follow the money. If you look at the MGM surveys very recently, majority of American businesses in mainland China would like to stay on. They are not thinking of leaving. And majority, according to American Chamber of Commerce, cite improvement in China's environment for doing business. Even the so-called trade balance is not what it seems. If you look only strictly at import-exports, yes, the US has a significant trade deficit with the People's Republic of China. But if you include, for example, iPhones, GM cars, Starbucks sold in China and made in China by American companies. So these are not shown up in export numbers. If you include the total relationship, in fact, the deficit suffered by the US in China is not really very large. It's something like 50 billion US, a fraction of the officially announced trade deficit number. So they are truths within truths. In fact, many people don't seem to realize that despite all the negative headlines, today, the biggest trading partner of the United States is actually China. It's not Mexico. It's not Canada. The two countries are very much mutually dependent on one another, I would say. China is a leading or principal source of attractively priced consumer products, credit, students, tourists to America, apart from emerging as the fastest growing domestic foreign market for American goods and services. You can't really take away that relationship overnight. So I am looking forward to a situation where these naturally complementary power countries that would in fact, allies during the last two world wars, the 20th century, will get back together again and find a degree of accommodation. And look, there's also not only the bilateral relationship, there's the world's problems. Together, China and the US are responsible for something like 43% of global carbon emissions. You need them to work together to really fight climate change. Together, the two countries are responsible for 52% of total global spending on the military. You need them not to fight each other if we are going to have real global security. I think politicians eventually will come to the conclusion.
The reality, Mr. Chia, right now the reality is there's a lot of tension between the two countries, and Hong Kong is getting caught in the middle of it. Details emerging now about the national security law that will be imposed in Hong Kong, which puts in doubt the one country, two system model. For value partners, for your company, does it remain committed to Hong Kong? How does it view developments in the city?
Look, I want to be frank with you, okay? My view is Hong Kong's real problems is not politics. It is the social and economic problems that Hong Kong that's building up in Hong Kong. I've been living in Hong Kong for quite a long time, and the amount of inequality in Hong Kong created by a system of monopoly capitalism, where only a small number of people are getting richer. Majority of Hong Kong people in the middle class have not seen any real increase in their living standards or purchasing power for at least 20, 30 years. And housing is totally unaffordable for young people. The system creates vast inequality. It denies access to opportunities for younger people. And the one effort we made a few years ago to introduce a one-man, one-vote system in Hong Kong in 2014, 2015 was defeated in the Legislative Council. So these are underlying problems that are still here, and in my view, are the major contributor. So Hong Kong's problems are more economic and social. And some evidence to back my view simply is that please notice that ever since the announcement of the national securities legislation, the level of protest action, even the efforts to hold a strike by protesters have failed. They are not able to gather the sufficient support from the public to make it happen. On the contrary, the Hong Kong stock market continues to go up. I think today the Hang Seng Index is up another roughly 1% after Mr. Trump came out with a fully intact trade deal statement. The market is looking past the legislation. The market basically seems to feel that the legislation have advantages and disadvantages, but basically it allows Hong Kong to leave behind a very contentious issue, which is the Hong Kong's obligation under one country, two systems to implement some sort of a national security law. Hong Kong had 23 years to do it. It was part of the deal signed between Britain and Beijing on Hong Kong's future. It never managed to happen. So now Beijing is imposing a version of it on Hong Kong after waiting for 23 years for Hong Kong to do it. So, but my point is, I think we have to move on and focus on the very real issues dividing Hong Kong society and denying young Hong Kong people access to economic and social opportunities. That is the real issue.
As an investor, would it make sense for you to shift some of your resources to perhaps Singapore?
Frankly, my eyes are more north than south, but they might be peculiar to my firm. So I'm not making a general statement here. Value Partners, as the largest independent brand in Hong Kong, is been actually more by luck than skill. We now have the biggest opportunity of our entire situation. We founded 27 years ago, which is the opening of mainland China to foreign and Hong Kong asset management companies. On 1st April 2020, little noticed by the media, China formally opened its doors in financial services to foreign brokers, banks, and asset management companies. And we aim to take full advantage of this great opportunity. This is just emerging as the world's biggest opportunity in a generation for the asset management industry. Huge pool of savings waiting to be managed, growing at double-digit figures per year. Value Partners has been cited by independent consultants as one of the top 10 foreign and Hong Kong companies active in the mainland Chinese market. We set up our office in Shanghai in 2011. So with due respect to Singapore, of course, we also have an office in Singapore, and we think Singapore is emerging as like, it's not emerging, actually it is like the Geneva of Asia. You know, it's a lot of private wealth management, etc., private banking, etc. But for us as an asset management company, China is the dream opportunity. I never really thought that we had such a great opportunity, but it's right there in front of us, and we are moving full steam ahead. We are raising money in China, we are manufacturing products in China, and we hope to be among those which will be able to get full access in the fairly near future.
I'll pick up on the China market just slightly in a bit. There is a question here from one participant, and the question is, have central banks created a floor for asset prices? Is there now no argument for a bearish position, you think, Mr. Chia?
I'm the old style value investing camp. I think the current market in the United States is in the very high risk territory. You don't need to be a genius to figure that out, actually. The PE of an S&P 500 is roughly 23 or 24, as I recall. And while the US economy is doing very badly, I mean, US GDP growth likely this year will be down 6.5%. But valuation of the stock market is an extreme high by any standard. So it's a very big mismatch between high valuation and poor economic performance. Something's got to give. So at some point, I think this kind of financial engineering that we are seeing, this kind of bubble economics that we are seeing that push problems to the future and embark in amazing, huge fiscal and monetary stimulus to keep the party going, it will result in tears. I am pessimistic. Now, I think the world is getting bifurcated because this is not true, though, of the China markets. Say what you like, China was first in, first out, thanks to their very effective control measures for the pandemic. They have been able to achieve a V-shaped recovery without resort to high risk and extreme fiscal and monetary measures. Chinese fiscal and monetary stimulus is modest by global standards, by US standards, and yet they are able to achieve positive economic growth now. And what to me is a quite convincing recovery at a time when their own market, as measured by Shanghai Asia Index, is only 13 times. So I think the value investors should be looking seriously at China-related stocks and bonds, while being cautious on US-related stocks. This is not some kind of a political statement. It's just a statement of fact and factual observation.
We often
I
talk
would say
about
another point.
bubbles. Where are these bubbles?
The bubble economy in the US was there before COVID-19. I think COVID-19 just brought it into the open as a catalyst. Since the global financial crisis, people like me, by the way, I used to be a reporter in the Asian Wall Street Journal, so I was a financial journalist before, many years ago. So I think the US system increasingly emphasizes financial engineering. It emphasizes kind of like the financial system taking over the real economy, and also avoiding the one thing America really needs from Asian eyes. America really needs to undergo a period of building up their savings, practicing austerity, and revamping and overhauling their basic infrastructure. But America, the system is such that it's difficult for any politician to do that without getting voted out of office. Because it's a consumption culture. It's a culture based on creating paper money, paper wealth, and also the system is such that the rich-poor gap is getting very, very serious. Yeah. So there are very underlying problems in America which can be described as a crisis. And this burst into the open when COVID-19 came. And then you get really like a very unreal feeling. The market keeps going up, a small number of people keeps benefiting, and then you even have people using what amounts to government stimulus checks to buy shares of bankrupt companies like hers. So looking from Asia, it seems quite strange, a bit disturbing, and doesn't appear to me to be very conducive to a soft landing in the years to come. I also want to make one other
Mr.
point
Chair, we have to
quickly,
move
which is
there. Go ahead.
yeah. Actually, if you look at it closely, America and China are converging in many ways because America, especially with COVID-19, is moving towards what seems like a form of state capitalism, where the Federal Reserve Bank and the federal government and the state governments increasingly intervene in the economy to try to so-called stimulate the economy, hand out checks to people to rescue them from their unemployment, and also create what amounts to a country industrial policy, which in the past they accused China of doing. While China, on the other hand, is moving towards market opening, deregulation, and providing more space for free markets. So it seems that the two countries are becoming more alike, not more unalike. It's a very interesting phenomenon. But in the end, I think they really need one another. I think the natural relationship between China and America has to be complementary and not competitive. It doesn't need to be.
On that note, Mr. Chair Cheng Hai, co-chair and co-CIO of Value Partners, we thank you for your insights today. Thank you very much, Mr. Chair.
Thank you, Haslinda. Pleasure talking to you.
Before we get to the banking panel, let's do our next polling question. The question on your screen: will we see a significant second wave of COVID-19 in 2020? Will we see significant second waves of COVID-19 in 2020? Yes, they will be deadly. Expect further lockdowns. No, infections will steadily decline. And the third one is the virus will remain, but there won't be a second wave. So far, initial reaction, 42% for yes, they'll be deadly. 6% saying no, infections will steadily decline. 54% saying the virus will remain, but there won't be a second wave. Of course, we've already seen the beginning of a second wave in South Korea, for instance, as well as in China. We'll tabulate all those votes and bring you the very latest just after this banking panel. Now, there's been a lot of talk about a new reality, a new normal, and some say the world will never be the same again. And the pandemic has certainly been a great financial shock for many. So what does that mean for the banking world post-COVID-19? How does it emerge from the crisis? Let's get insights from two of the sharpest minds in the banking world here in Asia. Piyush Gupta is CEO of DBS Bank, the largest lender in Southeast Asia. Piyush has been credited with transforming DBS into a leader in digital finance. He was named one of the world's top 100 best performing CEOs in the Harvard Business Review. Piyush, always good to have you with us. And we also have Filippo Gori. He's JP Morgan Asia Pacific CEO, a veteran banker with a 20-year career at the bank. Filippo has served as chairman of the Asia Securities Industry and Financial Markets Association since September 2018 and as a board member since 2014. Filippo, good to have you with us, gentlemen. Thank you. Now, one of the biggest changes arising from the virus is the digital shift. Some say what would have taken 8 years took just 8 weeks. Piyush, perhaps we can start with you. What's been the key changes you've seen in banking? What's been transformed?
Haslinda, it's good to be on the show with you as usual. But so I have a slightly different view. I think the transition to digital has been occurring apace over the past several years. For us, we started digitizing both our internal and external business capabilities several years ago. And I was just reflecting, in 2015, about 30% of our customers were engaging with us primarily digitally. By last year, that number was already up to about 53%. So this has been a gradual shift. Now, it is true that in the last couple of months, you've seen an acceleration of that shift. And the acceleration of the shift means that a lot of the people who were recalcitrant didn't have a choice. And frankly, that included a lot of older people. I found that people between 60 and 80 saw a fourfold increase in terms of using digital tools in the last couple of months. It's not a large number, it's in the thousands. But nevertheless, we're beginning to see the naysayers and the more recalcitrant people also getting online. So that's been one. The second actually has been more to do with the bank's capabilities. So even though we had a really good set of digital tools, the COVID showed us that we still had some gaps, what I call missing bridges. And therefore, you found some obscure reason why the customer would still not be able to fulfill the transaction online and would have had to reach out to the bank. And so we really accelerated building those bridges to complete this last mile capability. But perhaps most important, and for everybody, where this was really eye-opening was in the internal capability or our employees' ability to work from anywhere. That, of course, has been a game changer for everybody around the world. And I think that's been driven by both changes in the risk appetite of companies. We'll be willing to do things we might not normally have been willing to do, but perhaps also in the psychology of companies. A lot of managers, middle managers, senior managers would normally have been very reluctant to let people work from home. Even if you had official policies which let you do that. And that shift in the psychology of people has been profound. The recognition today that 90% of the people could safely work from home and do it over extended periods of time. I think that is really what's going to be the long-term game changer. I think that shift will lead to a lot more flexible working arrangements than we've seen in the past.
Philippe, let's bring you into this discussion from JP Morgan's perspective. What are some of the changes you've seen and how permanent are these changes?
Thank you very much, Aslinda. It's a pleasure to be here together with Piyush. I would echo some of the things that Piyush has just said. I think some of these changes were already in the making a few years back. And the digitalization and the virtualization of our banking business was already in the making. What COVID, though, has provided has been an incubator which has accelerated some of those trends and made them faster and made us reacting faster to some of the challenges that we were facing externally. Now, how much of these will become permanent? Remember that JP Morgan in Asia Pacific has only wholesale business, so no retail component. In my humble opinion, the longer the virus remains, the more prolonged the lockdowns and so on and so forth, the more some of those changes that we have implemented will become quasi-permanent. On the other hand, if we had the magic wand and the virus could be eliminated tomorrow, I think there would be we would go back to some of the old way of doing business. In that sense, we are observing, we are still learning. I think it's a little bit too early to say for us how this will change our way of operating in the region. For sure, we will keep on investing in the 17 countries in which we are present. Also, because the lack of traveling kind of require you to have a bigger onshore presence. But for more profound lessons learning, I think it's just a little bit too early to say.
The reason I ask is because one Young report. Go ahead.
So if I could comment on that, as I was going to say, so I think what's happened in the last couple of months is pretty much an extreme. The pendulum swung massively because you didn't have choices and options. I think without a doubt, as people start getting reconciled to this reality, the pendulum will swing back somewhat. I don't think it will go all the way back. Now, you take one good case point. When demonetization happened in India and Modi discontinued all the currencies, for the next several weeks, you didn't have a choice. You could only go and use a mobile payment instrument, and everybody said everything's going to go digital and mobile. A few months down the road, the degree of mobile use was up from historical levels, but it moderated down from the peaks. And I think you will see some element of that over here. So in our case, for example, in many of our countries, we have 80% plus of our people work from home through this 2-month period. There is no way that I expect to run with 80% of people working from home in perpetuity. I do think you'll have more flexible working, and therefore more people will have the options and choices to work from home. But I think for both long-term productivity, for employee morale, for psychology, and for culture reasons, it would be completely impractical to continue working like this forever. So I do think that you will see a correction and a shift at a level which is higher than the traditional levels, but not as extreme as what we've seen in the last couple of months.
Yeah, and Anslin, if I can
go ahead.
I can just say what Piyush was saying to conclude his thoughts. I think there is also an element of human interaction in the banking business, which underpins our business, and therefore I think employees, to a certain extent, notwithstanding the concern for their health, are also craving that element of human interaction. So there will be some sort of normalization within the parameters of what Piyush just described.
One of the issues or one of the changes would be in the payments behavior, I suppose. I mean, Visa has come out to say that contactless payments are soaring, and the question is really, have behaviors really changed to that end? Are we any closer to cash being eradicated? Piyush?
Well, cash has been rapidly declining again over several years. For the last 4 years, our total usage of cash.
By COVID-19.
Well, it has to have been, because partly you don't know. Fewer people have been going out, and therefore overall consumption has been down, and therefore it's hard to say whether the decline in cash is just because people weren't in the markets and the stores and everybody was doing online shopping. So when you do online shopping, obviously you don't use cash. Once you go back into the physical world, how much cash you use is still not entirely clear. But I think directionally, cash has been coming off. Our own cash has been down by 5 to 7% a year now for the last 4 or 5 years. So that's without a doubt, there is less cash. I think the alternative payment types are also proliferating. In addition to just plastic, debit and credit, you're seeing every kind of e-wallet and every kind of online real-time payment tool being made available to customers. Many of them are very convenient, so customers are taking to them in large measure. So I do think that trend will continue for the immediate future. Some of it can get further accelerated if you really wind up with some central bank digital currencies. Now, that is effectively central bank backed money, but it's in electronic form. So I think that could further accelerate the prospects. China is already experimenting with that in Suzhou and a couple of other places. However, and this is an important however, in Scandinavia, which obviously saw the demise of cash faster than anywhere else, there is a strong holdout of people who still want to use cash, to the extent that the legislature has had to start looking for rules and putting in rules that prohibit banks from shutting down any more ATMs and shutting down any more branches to be able to cater to this long tail. Similarly, I read a survey. Folks in Switzerland are very concerned about not having currency, because obviously currency has got one dramatic positive, and that is anonymity. Once you use cash, nobody can see what you spent it on. And in countries and situations where people value privacy, they want to use cash as opposed to leave an electronic trail every time they go and make an expenditure. So I think you might eventually wind up with a situation where you never have zero cash. But I do think you will have less cash in the future than you have today.
Filippo?
Yes, I agree that the trend is there, and it's clearly incredibly present in Asia Pacific. If you think about countries like Australia, where the digitalization of the banking business it's been at the forefront, or if you think about what's happening in Singapore, what's happening in China. In the rest of the world, I mean, being European, we still love cash, and mentally it's been difficult to move away from that. And the same way, if you look at the US, cash is still there. The same way credit cards have never really been replaced fully, even when we tried with some digital offering outside of Asia. So Asia, I would say, in that sense, is leading the charge in the digitalization of the banking business. And I think I agree with Piyush, the rest of the world will follow, but there are some cultural considerations for which there might be a delay in a cashless society, in that sense, to be upon us, because I believe in certain countries, European ones and in the US, cash still plays a dominant role. And to give you an idea,
some of this.
Sorry,
I think, just... Philip, between you and me, we don't need Haslinda. I think we're monopolizing her time.
Yeah, sorry, you're right. Please go ahead.
Go ahead. Okay, we'll go to Piyush, then we go to Filippo, and then I have a question. Go ahead.
Okay. I was going to say that, I think some of this is indeed cultural, but not entirely. As I was reflecting, the best example of elimination of cash is Europe, actually, because it's all over Scandinavia. So you go to Sweden, Denmark, Finland, including the Netherlands, there is no cash. And so you could argue it might be differences by country and not by continent. But I think one of the big enablers is the underlying infrastructure. So the places where either private sector, Alibaba, WeChat in China, or the public sector, the Aadhaar-based, the payment UPI payment system in India, or the Pay Now infrastructure in Singapore, where the infrastructure has been invested in, which makes it effortless and seamless and makes the customer journey very, very easy. People start taking up these alternative payment tools a lot more readily. The country where the infrastructure does not exist and there's a lot of friction, then people tend to stick with cash longer.
Filippo?
Yeah, I agree. The Southern European countries where I come from are probably in the latter category. Having said this, the final point I was trying to make is, as a firm, to give an idea, we still move around $6 trillion of cash every day in payments across the globe. And actually, during the crisis, those amounts have actually increased dramatically to normalize back again now. But we are still moving a huge amount of cash across the world.
There is a question here from a participant, and that, like, your view on how some banks are cutting or reducing dividends during the pandemic. Your thoughts on that? I mean, we're seeing that in Thailand, where the BOT just yesterday said exactly that. What are your thoughts on that, Filippo?
I think it's for the board of JP Morgan and for the US regulator to opine on it.
Go ahead. Piyush, go ahead.
I can't pass it on to the board of JP Morgan, so I guess I have to feel that one. But
okay, so we have
if you think about all the provisions and the bank strengthening done post 2009, it led to fairly robust levels of capital, and it also led to a protocol which said that you first exhaust your capital and other buffers, then you dip into counter-cyclical buffers, and after you get through counter-cyclical buffers, if you get to lower levels of point of non-viability, you bail in your tier 1, and etc., etc. It also set up some rules that when you dip into counter-cyclical buffers, that's when you're not allowed to pay dividend, and that's when you're not allowed to pay bonuses. So we set up a whole protocol as an industry to guide us on how to deal with and work our way through these kinds of situations. Now, if you look at the thinking around dividends, it's actually been quite bifurcated. Most of the European regulators took the view that even though the stress in the system is not visible right now, the banking system is not visible right now, the future prospects are so dire that it makes sense to discard the protocol we set up and push banks to start preserving capital right away by cutting back on dividend. some of the regulators in Asia, the Australians as well, went down that path. However, other regulators, the Americans were a good case point, but other regulators in the region as well, took the view that we should actually let the protocol work. And if the banks in the banking system demonstrate, both through their stress test and the ICAP capabilities, that they appear to have the capacity to be able to handle the crisis without actually having to cut back on dividends, then that's probably fine. So there were two different points of view. My own view on this was, at some point in the future, if it turns out that the crisis is a lot worse than people have predicted, or the losses are going to be so dire that you will have to get below capital floors, then that would be the appropriate time to start rethinking dividend policies as opposed to do it way ahead of time. But it's I don't have a strong view on that. I can understand why some regulators might take a more conservative stance as well.
Filippo, this one's for you. We've been talking about the rising US-China tensions. Given that situation, will you have to walk on eggshells? How will JP Morgan make big inroads into a country at such a time?
Look, the strategy that we had to invest in the region, in the 17 countries of the region, not only in China, but also in Japan, Australia, or Southeast Asia for that matter, or India, has been, was a strategy that was defined by the board a few years back, because this is a vibrant region, and it is considered the region where the most interesting opportunities for growth for the firm are appearing. In that sense, investing in China and having a large onshore presence was defined back already 5 years or so ago. We have to remember that JP Morgan has been in China since 1921. We are preparing our centenary anniversary for next year. And our strategy has been to be there to help both the international clients and the Chinese clients who need our help, especially when it comes to cross-border situation. And in the last few years, the flows, both inbound and outbound, that we have seen coming from China have been particularly remarkable. So, notwithstanding the geopolitical uncertainties, our strategy for the time being remains the same, which is keep on investing, keep up in the country and in helping our customer and clients in what their business needs. And we just got given last week another license, and hopefully we will complete all of those in time for the centenary next year.
That's right. JP Morgan was approved to fully own the Chinese futures unit. What are the priorities for the first 2 years, you think?
The priority for us is very simple. Owning 100% of the F&O company, arriving at owning 100% of the security company. We're working already towards owning 100% of the asset management company, and we already have a bank, the China Local Incorporated Bank. So arriving with this full set of licenses and starting deploying them, we have doubled our headcount over the last 6 years onshore in China, and then starting serving more and more clients. As I said, in both inbound and outbound capacity, that's our priority.
This one's for you, Piyush. You're big on digital payments. Wirecard has become a big player in digital payments in Singapore, as well as the rest of Asia as a whole. Do you see consumers and companies' confidence in Wirecard shaken, given the extent of missing money in other scandals? Is that an issue?
Well, it's hard for me to comment on how people might feel about Wirecard in particular, but it logically stands to reason that every time any company, Wirecard, anybody else, gets this degree of public scrutiny and negative PR, it does make people angry. So that has to be the case. I think Wirecard's big proposition is actually also as a merchant acquirer. So there could also be a degree of nervousness in other merchants who use them as a gateway. And that is not impossible. Now, if you ask me a broader question, do the challenges of Wirecard start spilling over to lack of confidence in other players in the e-payments or the electronic industry? I think the answer is probably no. I think there's I mean, you'll always find challenges and individual idiosyncratic problems in any industry, and Wirecard is likely to be one of those. I don't think they really reflect overall on e-payments or the industry in particular. So I don't see that having a significant impact on confidence in general on the e-payments regime or the infrastructure across the board.
We only have a couple of minutes left, and I just want to throw this question to both of you. We talked a lot on our shows about the disconnect between markets and economy. How do you view that disconnect? Have markets reacted the way you anticipated? Has it been rational, irrational? Have central banks encouraged risky behaviors in the markets? And, does it make you nervous? Let's start with Filippo.
I think Mary Erdos said it very well earlier this morning on your show when she runs our private wealth management, private bank and asset management. She said, markets are not emotional, investors are. So I think there is an element of emotions running across the investors community. At times is reacting to the geopolitical headlines, at times is reacting to the government, what the government are trying to do. My personal view, the government are trying to help the economies getting back on their feet, and they've done well in doing it exceptionally fast. Having said this, it is a long process, and I don't think we have yet seen the end of this crisis, and therefore it's a bit too early to see how the markets will go from here. There is a lot of emotions running wild, and there's a lot of discrepancies and dichotomies across various financial markets, as your previous speaker was just mentioning earlier on.
Yours, quickly, if I could have your perspective.
No, my perspective is actually quite similar. I do think that there is a dislocation between the real economy and the markets. I think that the amount of stress we will see in the real economy is going to be huge. Unemployment is one indicator of it. PPIs, consumption patterns, GDP rates, trade flows, everything suggests that the recovery is going to be long drawn out, including, by the way, in China. I don't necessarily agree with Xia that this V-shaped recovery is going to persist, because then China needs demand from the rest of the world as well. So I do think the world is in for an extended period of slow growth. And when that happens, it's hard to justify strong corporate earnings. And if you don't have strong corporate earnings, then it's hard to justify markets continuing to rise forever. So this is really, to a large extent, a liquidity-driven boom. There's a lot of money at work. It's also interesting that certainly in the US market, a lot of this is retail money. It is that proverbial auntie who's buying the day Portnoy's of the Twitter trade. All the intelligent money is frankly missed out on the bull run because they were looking at the fundamentals. But I think I'm also a value investor. I think fundamentals matter. And therefore, there's every likelihood that you will see a correction somewhere along the line, bring the financial markets more in line with the real sector. Longer term, I do think there are areas of opportunity, and I do think that digital economy and some of the shifts in behavior that we're seeing will create opportunities and for tech companies, digital companies, etc. But I do think there's a dislocation right now.
Here's Filippo. Great conversation. Hopefully next time we'll do it in person. Thank you so much for your insights today. Now, let's turn to India. This is Asia's third largest economy and is heading for its first contraction in more than 4 decades this year. It's bracing for a fiscal deficit blowout as the pandemic spreads. In fact, Fitch has followed Moody's in downgrading India's rating to the lowest investment grade, with the outlook capped on negative watch. I got some perspective from Dr. Krishnamurthy Subramaniam, who's the chief economic advisor for the Modi government.
Dr. Subramaniam, the central bank has said that the Indian economy will shrink this year. And we heard from Goldman saying that it could be the country's worst recession on record. To your knowledge, how challenging will the path to recovery be?
Haslinda, very good afternoon, and good afternoon to all the viewers. It's important to keep in perspective that this is impact on the economy that has been created by a global pandemic that is by far the most devastating that any of us has encountered in our lifetimes. And in not just India, but the rest of the global economy also is suffering the consequences of the pandemic. The key aspect that has to be kept in mind is, if you contrast with some of the earlier episodes, whether it was the Asian financial crisis or the global financial crisis, the uncertainty that these crises created were primarily economic. And so governments could, take steps to tackle the uncertainty. In this case, though, the uncertainty stems primarily from the health side. The fact that there is no vaccine yet for the pandemic, and therefore, various interventions that also have impact on the economy have been taken by various countries. So the primary source here is the uncertainty from the health side, and global economy itself is going to shrink. India is not an exception, in this globalized world.
So having said that, realistically, when do you think the recovery will start, and what's your GDP estimate for 2020?
Hasilta, I think it is important to again factor in the uncertainty here. So let me go and use some information about a pandemic. The pandemic that was of this scale, in fact worse, happened more than a century back, which was the Spanish flu in 1918 and 1919, which was far more devastating, because about 1/3 of the population was infected then. The mortality rate was about 10%. In contrast, even with the large numbers worldwide with COVID, less than 1% of the population, global population, is infected so far. The mortality rate, global average, is about 3.4%, which is 1/3 of what it was. So far less devastating. But the reason I use this is that the recovery in the Spanish flu was a V-shaped recovery. But that V-shaped recovery happened after the pandemic was brought under control. So, inferring from that, therefore, it is critical to take into account when will we be able to bring the current COVID pandemic under control. The recovery will happen after that uncertainty from the health side is taken care of. If it so happens that in the latter half of the year we have the vaccine, then one can anticipate the V-shaped recovery starting in the second half. Otherwise, it will have to be next year.
So you are confident that it will be a V-shaped recovery once the flu, the virus, comes under control?
I don't think anybody can be confident, with the kind of uncertainties that prevail. What one can say is that I would put my odds on a V-shaped recovery, greater odds on a V-shaped recovery. I think that would be fair to say.
Dr. Subramanian, many economists are saying that India's fiscal package of 21 trillion rupees was too little to ease the pain of the industry, to ease the pain of the poor. They say there should be more measures because the damage to the economy is bigger than earlier estimated. I mean, what are your thoughts on that? Does that make a case for a second round of stimulus?
So, a couple of points, Haslinda, on this. First, my office had looked at the packages that have been announced by various countries in great detail, OECD economies in particular. And one of the key aspects that stood out was that countries used the combination of fiscal, monetary, and liquidity measures. Just to give an example, if you take the package announced by the United Kingdom, which was supposed to be 15%, the overall package was 15%, but the fiscal component of that was a fraction, which was about 3.6, 3.7%. India is no exception on that as well. The overall package combined, when you combine fiscal, monetary, and liquidity measures, is about 10% of GDP, but the fiscal component is actually lower. Related to this is the fact that, countries have utilized more, have used more measures in the areas where there is greater space. In the Indian context, therefore, we've actually used more liquidity and monetary measures because that's where greater space was available. And as the Chinese premier Deng Xiaoping used to say, I don't care about the color of the cat as long as it catches mice. I have a similar philosophy with respect to these measures as well. As long as actually it takes care of the stakeholders and ensures that some of the damages are limited, I think that's all one cares about. The second point being,
but having said that, Dr. Subramanian, when you take a look at the actual fiscal impact, according to some economists, it amounts to only 1% of GDP, which is really low. Why the fiscal prudence? Are fiscal constraints holding back the government from spending more?
No, I was actually, in fact, coming to that point, Haslinda. As I was referring earlier, the uncertainty, that prevails, and uncertainty affects demand side because, people typically will not spend as much on discretionary goods and services till the uncertainty prevails because of what is called the precautionary motive to save. For instance, last week or a couple of weeks back, one of the foremost economists of our generation, Joseph Stiglitz, also wrote about this, in fact, questioning whether, while the uncertainty persists, whether it makes sense to actually, to sort of have some demand side impact. In fact, if, there is some analysis now done by the National Bureau of Economic Research for the United States, which also shows that the checks that have been sent, have been used primarily for spending on essential items like food, not on discretionary spending. For instance, spending on durable goods has not picked up at all despite the checks being mailed. The point I'm trying to make is that, when the uncertainty persists, demand side measures may not have as much bang for the buck, but once the uncertainty settles down, then demand side measures would make a lot more sense. And therefore, as a policymaker, it is important to try and ensure that the timing of the measures is also correct so that the maximum bang for the buck is generated.
Dr. Subramanian, I want to touch on India's fiscal deficit target. India missed it last year, and the gap came at about 4.6% of GDP. Your government had set a target of 3.5% this year. How would that change, considering that the government has announced more than 50% increase in borrowing?
Again, Haslinda, I think, these are extraordinary times, and extraordinary times, normal, constraints cannot necessarily be used to understand situations like these. There is going to be an increase in the fiscal deficit because of the, the revenue prospects actually obviously have gotten impacted by the pandemic. The lockdown had brought down economic activity. And so, it's undeniable that there will be a fiscal impact. And again, this is something that is not restricted only to India. It will happen worldwide. What is pertinent to keep in mind in the Indian context, though, and this is something that, my office has done some very careful analysis on, is when you look at fiscal deficit, you care finally about debt sustainability. Because fiscal deficit is basically, as our viewers understand, that's the difference between revenues and the expenditures of the government, including interest expenses in a particular year. But debt sustainability is when you look at it in a dynamic sense. And there, what is favorable for India is that we, even in a bad year, from next year onwards, we should be able to grow at 4-5% for sure. But maybe more. And therefore, debt sustainability, which depends on the difference between the growth rate and the cost of capital in nominal terms, would basically help us, because a high growth trajectory can bring debt sustainability. So I am not worried as much about the fiscal deficit, because given the high growth, we should be able to sustain the debt.
Looks like we've covered the world today. Thank you so much for joining us on the second day of Invest Global. We hope you've enjoyed these discussions. Thanks again to our speakers. I'd also like to thank our sponsors: US founding sponsor Invesco QQQ, Europe sponsor CMC Markets, Middle East Africa sponsor EcoBank. Thank you so much. And stay tuned for our day 2 sessions in the Middle East, followed by London and concluding in New York. Each event begins at 1 p.m. local time. You can see all of the sessions from across the globe archived here on Bloomberg Invest Global Event Hub, along with recap videos, Bloomberg intelligence data, as well as resources from our sponsors. Tomorrow at 1 p.m., My colleague Tracy Alloway in Hong Kong will be back here for our third day of Invest Global. Of course, you can follow us at Bloomberg Live on Twitter and LinkedIn for updates. And please also be sure to follow our ongoing financial and markets coverage at Business and on Bloomberg.com. If you haven't already, please consider subscribing on Bloomberg.com/subscriptions. Thank you all. Have a wonderful day ahead.